Hello, I'm John Ward on behalf of Anglo Far East and Physical Gold Fund. We're delighted, as always, to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. He's the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis. And most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, which is just on the brink of publication. Welcome, Jim, and thank you for joining us.
Thank you, John. Glad to be with you.
Well, Jim, we're always excited to get questions from people following you on Twitter. A reminder to our listeners, just use the hashtag AskJimRickards wherever you are on Twitter. And here's a timely question from @EdMcGrath. Jim, do the unfolding events in Crimea accelerate or intensify the existing currency wars?
They do. They can be understood as part of the currency wars broadly defined. And when I say broadly defined, I would really expand the aperture a little bit to include financial wars. So that's currency wars plus other economic means of competition, other economic sanctions. So, of course, traditional warfare is what we call kinetic, so that's things that shoot or explode, or missiles or ships or torpedoes or whatever. But then beyond that, you have what's called asymmetric or unrestricted warfare, which includes weapons of mass destruction, chemical, biological agents, cyber warfare, and financial warfare. So currency wars are a part of that silo, if you will. And I think Crimea, the situation in Crimea and vis-a-vis Russia and Ukraine, is a very good illustration of this, because no one in the United States or NATO or Europe, for that matter, thinks that we should use military force to stop Putin. Nobody thinks the 82nd Airborne should, hop into Sevastopol. So that's off the table, and there's general agreement on that. But so that immediately begs the question: well, if you're going to do something and it's not going to be military, what will it be? And of course, economic sanctions come into play. But what's interesting about this case is that the United States has imposed some sanctions. Frankly, they're very tame, although I did expect that they would be tame and would not have much effect at all, because unlike Syria and Libya and Iran and North Korea and some of the other targets of U.S. sanctions, Russia can fight back. And maybe we'll talk a little bit more about that in detail, but precisely because Russia can fight back in the financial realm, the U.S. doesn't want to escalate. The U.S. will probably suffer more than Russia if we have a full-scale financial war. And so I don't expect this to go very far. But yes, I think it's a good question, and it's a good example of how currency wars are more of an economic rather than a military or strategic phenomena, because we've seen competitive currency devaluations in the past. But it's a good example of how you can sort of segue from currency wars to financial wars to possibly shooting wars, trade wars, and other kinds of escalation that can make things a lot worse, as we've seen before, and we could be seeing that again.
Well, let's delve into some of the details here. And some of this, of course, is media chatter and may just be sort of myth that needs to be scotched. But I've seen, for example, talk of punishing the Russians by shutting them out of SWIFT, the international system for bank settlements. Do you think that scenario is remotely likely? And if it were enacted, what might be the unintended consequences?
Well, I don't think it's likely at all, John, but I do think in analyzing this, we should separate what's possible from what's actually going to be done. Now, is it possible that Russia could be kicked out of SWIFT? Yeah, that's possible. The U.S. and its allies kicked Iran out of SWIFT and had a very devastating effect on the Iranian economy. But of course, when you compare Iran to Russia, you find that Iran is a much smaller economy, much less connected to the global trading system, the global financial system, and of course, the U.S. has barely spoken to Iran since 1979. So in some ways, it was an extension of the fact that we had already isolated them. Russia is completely different. Russia is, 1/8 the size of the U.S. economy, so it's over about a $2 trillion economy. Very large economy by international standards. The world's largest energy exporter. A lot of people might guess that would be Saudi Arabia, but it's not. It's Russia, both oil and natural gas. Lots of cross investments, lots of Russian investments abroad, lots of foreign investment, including U.S. investment in Russia. So you could kick Russia out of SWIFT, and that would be very devastating to them. But for precisely that reason, Russia would fight back in ways that are very detrimental to the global economy. I mean, that would be just the kind of thing that I've argued consistently, and I continue to take the view that the world's in a depression, global depression has been since 2007, But this would make the depression far more acute and would take us from just below trend growth, which is one definition of a depression, to negative growth, which is a much more severe phase. So we could kick them out of SWIFT, but we're not going to, and the reason is that A, they'll fight back, and B, we have a lot more to lose than the Russians. So I don't expect these economic sanctions to go very far.
Well, let's look at the other side of the table. What about what Russia might do? Again, it may be just loose talk, but I've seen reference to the possibility of Russia defaulting on its loans to U.S. companies and institutions. Is that a possible or even a probable scenario?
Well, I don't think it certainly is. I don't think Russia will do that sort of on its own or out of the blue, because they've got what they want. They took over Crimea. They now control Crimea. I'm actually looking at today's headlines. Ukrainian troops are withdrawing. Of course, the Russians have already occupied it. They ran a referendum. They got the vote to join Russia, and Putin and the Russian parliament, the Duma, immediately took steps to make that all happen. So effectively, as we speak, Crimea is part of Russia. So the fact that Ukrainian troops are now withdrawing is more a recognition of reality than any, kind of setback for them, because this was already a done deal. So Russia doesn't have to do anything right now. They've got what they want. The question is, what will the West do to try to punish Russia? And I've already mentioned that the West will not go very far for the reason you mentioned. Let's just say we use sanctions that did have some bite, not the mild ones. What the president actually did the other day was the equivalent of saying, a couple of oligarchs can't go to the Super Bowl, or maybe some Russian mid-level ministerial official goes to Geneva and his credit card doesn't work. That's the kind of tame, meaningless sanctions that we've actually imposed. But let's say we did something a lot more significant. We started trying to freeze Putin's personal assets, which are in Austria and Switzerland and other locations, or we froze Russian assets abroad, business and financial assets, not just personal accounts. So those are much more significant. Well, Russia has already said they would not take that lying down. They postured and talked about turning away from the dollar, but beyond that, they could refuse to pay their dollar-denominated debt. They could sell U.S. treasuries, which would cause U.S. interest rates to rise, at a time when the Fed is doing everything possible to keep rates low, so-called financial repression. The Russians would definitely be in a position to cause interest rates to rise, hurt the housing market, the stock market, and the U.S. economic recovery, as anemic as it is, possibly drive that into actually negative growth by dumping those treasury bills and causing interest rates to rise, or treasury notes, and causing interest rates to rise. So there's a lot Russia can do. But beyond that, they have even more dangerous weapons, such as using their hackers to shut down the New York Stock Exchange. I've mentioned that a number of times in some recent interviews and comments on my Twitter feed. And, of course, I'm accustomed to getting the usual amount of ridicule. They say, they can't do that. And I ask people, well, what happened on August 22nd, 2013? The NASDAQ was shut down for half a day. And there has never been a credible explanation given as to what caused that. Now, I said at the time that it could very well be Iranian hackers. That was a stage when the U.S. and Iran, before the sort of détente of December 2013, you go back to last August 2013, that it was very tense between the U.S. and Iran. So it could have been Iranian hackers, Syrian hackers, or Russian hackers just trying to see what works. So don't doubt that Russian hackers could wreak havoc in our financial markets and shut down the New York Stock Exchange. And then another response was, well, we must have good hackers. We could close down the Moscow Stock Exchange. And of course we do. The U.S. is just as good at this as any other power. But think about that for a second. So they shut down the New York Stock Exchange. We shut down the Moscow Stock Exchange. Who loses? We lose, because our markets are much bigger, much more important. There's much more wealth involved, much greater spillover effects. Bob Dylan had a famous line in one of the songs, when you ain't got nothing, you got nothing to lose. And Russia, financially is in a position of not having that much to lose, whereas we have a lot to lose. So for precisely that reason, we're not going to escalate, because it ends badly for us, for the United States.
I get that, and I get what you say that, Russians just sort of got what they want, so they're not particularly motivated for another aggressive move. But I'd still like to just explore this question of their relation to the dollar, and particularly to the petrodollar, to the use of dollar in the energy markets. Jim Sinclair, I was watching an interview recently, and he said, well, if the Russians wanted to play hardball, the very simple thing they can do is just accept other currencies in payment for their energy. And doing so, they would have a very destabilizing effect on the dollar. I'm curious to know what your take on that possibility is, and if you think it's remotely likely that Russia actually would move to abandoning the petrodollar?
I would separate long-term trends or even intermediate-term trends. I mean, we're not talking that long, sort of maybe, 3-4 years, somewhere in there. I would separate those kind of trends from what's going to happen, next day or next week or next month. In the very short run, Russia cannot turn their back on the dollar. It's not because they love the dollar. They would love to get out of the dollar system, get out of the petrodollar. But the problem is you can use anything you want for a trade currency. Trading between two parties is just a matter of keeping score. So, I ship goods to you and you pay me, and you ship goods to me and I pay you, and we have two-way payments and we can net those out. That's the balance of trade, obviously, and it gets settled up periodically. Well, you can count that in dollars. You can count it in baseball cards or bottle caps. I mean, any numeraire, any unit of account is sufficient for that purpose. But when I actually make the money, I'm going to want to get paid in dollars because I have to invest it. And that's the difference between a trade currency and a reserve currency. The significance of a reserve currency, it's where you park your reserves, what you actually invest in once you've made, profits on the current account or you have a capital account surplus. Now, the problem is there is no market in the world that comes close to the U.S. Treasury market as a place that can absorb the kind of capital flows we're talking about. We're talking about trillions of dollars when you add up Russia and China and Taiwan and Japan and others, trillions of dollars of reserve positions that have to be invested. So in the short run, there is nowhere to go except for the dollar. Having said that, there is no doubt that Russia and China and others would like to get out from under this dollar hegemony. They would like a system that is not based on the dollar. And so there are a lot of straws in the wind. I don't think Russia could overthrow the dollar on its own. But operating jointly with China and Saudi Arabia, that's a possibility. Now, what's the likelihood of that? Well, we've had some very interesting developments recently, which is that, of course, last December, President Obama effectively anointed Iran as the regional hegemonic power in the Persian Gulf. Clearly, these talks are going nowhere, but they like the appearance of talks, and Iran is being allowed to keep its nuclear reactor, keep its enrichment program, even though they promised not to go above certain thresholds, etc. Well, that's really a recognition of Iran as the regional power. Well, that's been taken as a stab in the back by Saudi Arabia. And, of course, the petrodollar deal for going back to, over 40 years to the Nixon administration, Henry Kissinger, was that we, the United States, would ensure Saudi Arabia's national security, in exchange for which they would require that oil be priced in dollars. And, of course, once oil is priced in dollars, if everyone needs oil, which they do, that means everyone needs dollars to pay for it. And that's a very strong underpinning of the dollar as the global reserve currency. Now, so combine all these things we're talking about. China's very fearful because they've got $4 trillion of U.S. dollar debt in their reserve positions, and they're worried we're going to inflate the currency. Russia wants to turn us back on the dollar because we're opposing their ambitions in Eastern Europe and Central Asia. Saudi Arabia may want to turn their back on the dollar because we've anointed Iran as the regional hegemonic power. So you've got three very powerful nations, all of them net exporters, Russia exporting energy, China exporting manufactured goods, Saudi Arabia also exporting energy. And the combination of these are all important straws in the wind, but the combination of the three of them over an intermediate period of time, that could be the end of the dollar. And that, because that's what I talked about in my new book, The Death of Money. But the death of money is really the death of the dollar, because the dollar is 60% of global reserves. If the dollar goes, the whole system goes, and that's what I'm expecting. So these are all very important straws in the wind. By itself, could Russia, abandon the dollar tomorrow? No, that's not likely. But over time, in conjunction with China and Saudi Arabia and others, could they overthrow the dollar? Not only is that possible, I actually expect that.
Actually, as I recall in Currency Wars, when you described the financial war game that you participated in for the US government, one of the things you did in that war game was to contemplate some level of collusion between Russia and China in just this direction. What's your read of the level of collaboration or collaborative thinking between Russia and China? I'm sure they have their areas of hostility as well as collaboration. Do you think that they are talking to each other in this kind of terms?
Well, that's a very interesting and timely question, John. Let me just go back for a second to the war game that I talked about in Chapter 1 and Chapter 2 of Currency Wars. Now, that book came out in 2011. I was writing about a war game that took place in 2009. And at that war game, along with some others, I was part of the game. I was one of the game designers, game facilitators, but I also played on the China team, and a colleague of mine, a friend of mine, played on the Russia team, and together we cooked up this plan And we said, Russia and China would combine their gold reserves, place it in a Swiss vault, issue a new currency backed by that gold out of a London bank, and require going forward that if you wanted to buy Russian energy or Chinese manufactured goods, they would no longer take dollars. They would only take this new currency. And oh, by the way, if you wanted some, you could earn it, or you could deposit your gold side by side with the Russian and Chinese, and you would get some currency from this bank. The bank would issue it, of course, backed by gold. So all of a sudden you had a new gold standard, a new currency sponsored by Russia and China, with others invited to participate, and a very urgent need to use it because you would have to use it to get Russian and Chinese exports. Well, that was the scenario, and we knew it wasn't something that was going to happen the next day, but of course the whole point of a war game is to do some out-of-the-box thinking and help the Pentagon, sort of look forward, look over the horizon, and that was our purpose in doing it. Now, I will say at the time, we were ridiculed by some of our fellow participants. And these are prominent individuals, no need to mention names, but whether it's Harvard professors or think tank gurus or uniformed military, people said, well, you're being silly, in effect. Gold's not part of the international monetary system. Why are you even talking about it? It'll never have a role to play, etc. Well, that's fine. You sort of grin and bear it. But since then, since we did this exercise, Russia has increased its gold reserves 70%, increased its gold reserves several 100%. No one knows the exact number because they're non-transparent, but whether it's 200% or 300%, either way, it's a very significant increase. So in other words, China and Russia are behaving exactly the way we predicted they would behave back in 2009. And so have they completed that process? No, they haven't. Do they have all the gold they want? No, they're still very large buyers of gold. Interestingly, the Russians are much more transparent than the Chinese. If you go to the Central Bank of Russia website, they actually publish the amount of official gold they have, and it goes up in steady increments, 3, 4, 5 tons a month, but sometimes more. But of course, that can be 50 to 100 tons a year. Play that out over 10 years, and you're looking at 1,000 tons, and that's what Russia's doing. China is acquiring even more gold, but they're non-transparent about it. So my advice for everyday investors, whether you're an institution, a high net worth individual, or even everyday citizen, is to get some gold. In other words, if it's good enough for China, or put differently, China is acquiring gold hand over fist. What do they know that you don't? I mean, either the Chinese are dumb, or they know something the rest of us don't know. And in my view, it's the latter. That is, they can see the crack up of the international monetary system coming. They're preparing for it by acquiring gold, and other investors should do the same.
In all this conversation about the sort of global strategic maneuvers that people are taking, let's say Russia and China, there's a certain assumption, sort of a game theory assumption, I guess, of a kind of rational players. In a recent article, you mentioned the principle of mutual assured destruction, and you said that it applied to financial wars just as it does to nuclear war.
Right.
But of course, that mutual assured destruction principle assumes that the players are going to behave rationally. And looking at Putin particularly, do you trust Putin to act rationally? I mean, some people have described the Crimea adventure as a reckless kind of error, and others have really frankly suggested that Putin is losing his marbles. Is it possible that Putin would make a financial attack on the US that is counter to Russia's best interest and nevertheless very destructive?
Well, let's separate Putin's rationality from whether he might launch a financial attack. I would say that a lot of and you're right, John, those remarks that you quoted were spoken by various public officials. I consider that actually to be an embarrassment on their part. I mean, Putin is completely rational. He's uber rational. He knows exactly what he's doing. He's played this brilliantly. In other words, he invades Crimea. He knows, for example, that the United States and NATO, for that matter, are war-weary, having fought for, at this point, 13 years in Afghanistan and Iraq and elsewhere. That there's not much appetite for war, and a very, very low probability that anyone would do anything about it militarily. And then beyond that, you say, okay, what about economic sanctions? And we've already discussed the fact that the economic sanctions can only be tokens because of the risk of retaliation and escalation, exactly the kind of mutual assured financial destruction you mentioned. For some of the younger viewers who may not, remember Cold War game theoretic scenarios, the deal was the United States had enough missiles to completely destroy Russia. Russia had enough missiles to completely destroy the United States. So there was a great temptation to shoot first. You say, well, gee, if I launch my missiles and wipe out the other guy, I win. But what happened was people built up their missile forces in such a way that they could withstand a first strike and still have enough left over to launch a second strike, and the second strike would devastate the party that started the war in the first place. It was that second strike capability that prevented the other guy from launching the missiles in the first place. And again, if this sounds sort of abstract, it was abstract. It was like playing chess and trying to think 3 moves ahead. At the time, we analogized it to 2 scorpions in a bottle. You have 2 scorpions in a bottle. One can sting the other and kill it, but in its death throes, it has just enough strength left to sting back, and they both die. So rationally, you wouldn't even go there. That was true of the Cold War. That was called mutual assured destruction, or MAD, M-A-D. Today, we have mutual assured financial destruction. The U.S. will not escalate because they know the Russians can strike back, and the U.S. has more to lose, so it's not going to go there. Now, Putin knows that as well, and that's why that's one of the reasons he invaded Crimea with confidence, knowing full well that the U.S. could not escalate in financial space because we would lose more than he does. And so that's the mark of a very rational player, not an irrational player. Now, where it does get dangerous is the accidental launching of war, not the irrational or crazy act, but the accidental act. And there were 2 very famous movies in the early 1960s at the height of the Cold War. You know, I was in elementary school doing duck and cover drills. We all knew where the local fallout shelter was. We all knew what we were supposed to do in the event of a nuclear attack. They tested, emergency warning systems all the time. That was the environment we grew up in. And there were 2 black and white movies. One of them was called Fail Safe, and the other one, Dr. Strangelove. One was a very serious drama. The other one was a bit of a black comedy. But they both had scenarios of a nuclear war beginning by accident through, breaches in either computer systems or some accident in the chain of command. Now, that's the kind of thing, if you're going to take your hackers and ask them to come up with the ability to shut down the New York Stock Exchange, well, they sort of have to practice that. They have to sort of probe. And, every now and then you hear about these data breaches, and someone says, well, there was a data breach, but nothing happened. Well, maybe nothing happened, but it sounds like somebody was probing your system, looking for ways in. You could have a situation where Russian hackers don't intend to start a financial panic, but they're probing, practicing, and they accidentally start a financial panic or shut down an exchange. That is a much more worrying scenario because it doesn't require irrationality. It only requires accident, and of course accidents happen all the time. But one more reason to have gold. Gold is the one thing you can't wipe out digitally. Whether it's Bitcoin or the New York Stock Exchange, these are all digital systems. Gold is not a digital system, it's a physical system. It's the one thing you can't wipe out with a computer.
Back home, Jim, here is Janet Yellen, just today as we are recording this, has been chairing her first Federal Open Market Committee, and the announcements have come out. I believe from your point of view there were no great surprises, but I'd like to hear your take on today's announcements from that meeting.
Well, there was one shock, actually, and I guess people are shocked that she said she made such a shocking remark. Now, in terms of the basic expectations, the baseline, they did reduce asset purchases by an additional $10 billion, so $10 billion is so-called tapering. Everyone expected that, and they did it. They did abandon their 6.5% unemployment threshold. When in December 2012, they famously said that they would not raise rates until unemployment was at least 6.5%. Again, that was a threshold, not a trigger. Of course, we're extremely close to 6.5% right now, but they want to reassure markets that we're nowhere close to raising rates. And so, of course, they just abandoned the benchmark. And so if unemployment goes to 6.5, 6.4, 6.3, as of today, the Fed has gotten rid of that benchmark, and so it's not supposed to mean anything, although I make the point that the Fed has had at least 15 separate policies in the last 5 years. So if you have 15 policies in 5 years, it just shows you don't know what you're doing. So the Fed did abandon that benchmark, but I don't have any confidence that they won't put it back if it suits them because they make it up as they go along. So those two things, $10 billion of tapering and abandoning the 6.5% benchmark were for unemployment were expected, and they happened. So to that extent, you're right. It played out as scripted. But in the press conference, not the meeting itself and not the statement, the policy statement, but in the press conference, a reporter asked Janet Yellen, the Fed's official statement is that rates will remain low for a considerable period. And those are the exact words the Fed uses, considerable period of time. And, of course, these are all wordsmithed and nuanced, and everyone contemplates what they mean. And the reporter said, well, what do you mean by that? And she said, from the time we finished tapering to the time we hit our thresholds, it's about 6 months. Yeah, she hedged a little bit, but she actually used the word 6 months. I think a lot of market participants thought it might be longer than that, perhaps a year. So that immediately caused the stock market to drop precipitously. Bond market went down. Interest rates went up. So she really dropped a bombshell, very uncharacteristic of a Fed chair to be that specific. Alan Greenspan was famously told that, someone understood what he said, and he said, well, I must not have done a very good job. In other words, you're not supposed to understand what a Fed chairman says. But I have to say, Yellen is a little refreshing in the sense that she seems so kind of, nerdy and typical PhD financial economist that she actually says some very candid things. Whether she realizes the impact or not, who knows? But she did drop a bombshell. Now, the question is, what's the Fed going to do? They've actually hurt the markets with this 6-month language. It certainly suggests that they think things are better than perhaps the market expected. The rates will go up sooner than perhaps the market expected. So they may spend the next month walking that back because of her candor. I made the point, I said this on Twitter, that she committed a blunder, but her blunder was to speak the truth. Markets actually like to be lied to.
Well, given let me call it your commitment to the concept of complex systems, which I find a very compelling aspect of your first book, and I'm thinking about a very large complex system that would embrace, on the one hand, what's going on in Crimea, and on the other hand, what happened today at the Federal Open Market Committee. How would you weave these events together? What are the connections and the interrelations that you see?
John, what we can be sure of is that there are connections and interrelations and so-called spillover effects. We can be certain of that because that's the nature of network nodes, and if you apply graph theory to the way financial nodes are actually laid out, that conclusion is inescapable. The problem is they're very difficult to see. And I'll give you a concrete example. I was in Tokyo in September 2007, and you recall that was right after the housing market started to crash. Now, the panic came in 2008 with Lehman Brothers and AIG, but the crisis really started in the summer of 2007. So I was in Tokyo in September 2007, and the Tokyo stock market was crashing. And my Japanese friend said, wait a second, we don't understand. We understand that you Americans have a mortgage problem. We get that. But what does that have to do with Japanese stocks? Why is our stock market going down? And I explained that when you're in financial distress, you don't sell what you want, you sell what you can. And what was happening was that hedge funds and other leveraged investors in the United States were getting margin calls on their bad mortgages. They would have loved to sell the mortgages, but there was no market for them at the time, or other asset-backed securities. So they were dumping Japanese stocks, not because they hated Japanese stocks, they probably liked them, but because they were liquid and they could get cash to meet the margin calls on the other positions. So there's a very simple example, a very clear-cut example of how distress in U.S. mortgage markets caused a significant decline in the Japanese stock market, even though those two things don't necessarily correlate that well and really don't have anything to do with each other. So with that as an illustration, and going back to your question about, Janet Yellen setting off alarm bells with her 6-month remark, economic, loose talk about economic sanctions flying around. Crimea is going to the ruble. I mean, they're going to have the Russian ruble. They're part of Russia. Those banks are going to have to, collect the old currency and issue the new currency and reprogram computers and do, almost like a Y2K type of thing, or the introduction of the euro where you had to collect all the old French francs and issue the new currency. Investments drying up. And I'll give you another concrete example. The U.S. is the leader in satellite technology. The U.S. is the world leader in satellite technology for communications, entertainment, but also, military and intelligence capabilities. Boeing is a big, a major firm in that. Well, we may make the satellites. We may make those satellites in the United States, but they're launched in Russia. We outsource the launch of our satellites to the Russians. And so if you let this, Russian-U.S. animosity go too far and we start cutting off trade and other business relationships with each other, well, all of a sudden the skies go dark. We can't launch new missiles. Our intelligence goes blind. Not all at once, but at the margin. So that's an example how you can't let those things get too far out of control. But the danger is they do. The connections are hidden. They're there, but they're hidden, and we don't know about them until it's too late. It's when the dominoes actually start to fall and the losses emerge out of this sort of complex soup that we begin to see the problem. But we should understand that it's always there, And the more you probe and push and stress the system, and the larger the system is, the more likely you are to have these very catastrophic outcomes.
Well, lastly, let me ask you, you've mentioned gold a couple of times in our conversation. It naturally belongs in the story. But the events we've been talking about today and the complexities we've been talking about, do they affect your perception of where gold is headed and what value gold has as a protective investment?
Well, they certainly, I would say they're consistent with my view that all investors should have some allocation to gold. Now, by the way, I'm an advocate for gold, but I recommend 10 to 20% of your investable assets in gold. That would be 10% for the conservative investor, 20% for the aggressive investor, recognizing that gold is volatile. I think people have to be, candid about the volatility. But there are really sort of three reasons for that. One is technical. One is fundamental, and the other one involves an insurance concept. I'll just take those one at a time. The fundamental case for gold has to do with the fact that central bank policy is in the money printing that's going on all over the world, Bank of England, Bank of Japan, the Federal Reserve, People's Bank of China. Interestingly, People's Bank of China has printed more money than the Fed. So you have this massive money printing. Right now it's going into assets. It's not showing up as consumer price inflation, but you can think of the stock market, the housing markets, and other markets as asset markets as bubbles. We all know bubbles burst. They don't burst right away. They can go on a lot longer than we expect, but they will burst. So that's an accident waiting to happen. Or that money will start to, there'll be behavioral change. Inflationary expectations will be increased. That money will start to show up in price indices, and the Fed thinks they can dial it back. They'll find out that they're mistaken about that. In other words, it's very, very difficult to change behavior. But once you do, it's equally difficult to change it back again, and so then the inflation runs out of control that way. And if you have a loss of confidence in the paper money system, which is what inflation really is, the central banks may have to restore confidence by going back to some kind of gold standard or gold reference price. There's not a central bank in the world that wants a gold standard, but they may have to go to a gold standard to restore confidence. And if you do, it begs the question, well, what is the right price? Because if you do it at current levels, say around $1,350 an ounce or $1,400 an ounce, that is extremely deflationary. Given the quantity of gold, if you're going to have a gold standard where the money's tied to gold at $1,400 an ounce, you're going to have to drastically cut the money supply, which is very deflationary. So therefore, if there's going to be a link between money and gold, the price, the implied non-deflationary price, is $7,000 to $9,000 an ounce. So when I mention those numbers, I'm not picking a big number just to get a headline, and I'm not trying to be provocative. It's actually eighth grade math. You just do the ratio of paper money to gold and say, what price do I have to have so that I can support the paper money supply I have today and still finance world trade and world commerce? And the answer is, in that range, $7,000 to $9,000 an ounce, possibly higher, by the way. That's based on some assumptions. I'm sort of assuming 40% backing of M1. If you wanted to do 100% backing of M2, that number is closer to $50,000 an ounce. Now, I'm not predicting $50,000 gold, but it's a simple example of where gold would have to be if you wanted 100% backing for M2. So that's the fundamental case. The technical case, which is volatile, is very well set up for a rally in gold. In fact, I said that late last year, late in 2013, and that has played out so far this year. And that has to do with the fact that, we all know that gold performed poorly in 2013, but there was a very specific reason for that, which is the GLD warehouse. The dealers who control the warehouse raided the warehouse. They disgorged 500 tons of gold and put that on the market. That gold went to China, by the way. The GLD warehouse was in London. The gold was shipped from London to Switzerland. It was refined from 400-ounce bars into 1 kilo bars, 4 nines, and then sent to China. It's been buried. Now, when gold goes from the GLD warehouse to China, there's no change in the total supply, but there's a reduction in the floating supply. Floating supply is the gold that's available for transactions and leasing and forward sales and all of that. China doesn't do that. When they get the gold, they put it in the ground, and they're going to keep it there indefinitely. So you see the floating supply shrinking. Even if gold is leveraged, 50 or 100 to 1, paper to physical, if you reduce the physical, you have to reduce the paper contracts. You have to reduce the paper shorts. You're still leveraged, but you have to reduce them because there's not as much physical to go around. So that need to reduce paper shorts because of the declining floating supply was a very good technical setup for gold, and it's played out that way. So the fundamentals point to much higher prices in the long run. The technicals point to an upward trend in the short run. But the third concept is what I call insurance. So I just say to people, do you have a house? And most people say yes. And I say, do you have insurance on your house? And they go, of course I do. And I say, fine, do you want your house to burn down? And they say, no, I don't want that. I said, well, why do you have the insurance if you don't want your house to burn down? They say, well, it might. So in other words, the premium you pay is not considered a loss, or it's considered a prudent thing to do in case the worst happens. Same thing with gold. Even if you're not a gold bull, even if you don't really cling to the fundamental and the technical case that I just laid out, you might want a little gold in your portfolio just in case, which I believe is the case, that the stock market is a bubble and it crashes 30%, where inflation does break out. Your other asset classes will be collapsing, but your gold will do very well. Gold could go up 2 or 3 or 4 times in that environment. So maybe gold goes sideways, but you're still making money on the rest of your portfolio. But if the rest of your portfolio crashes, that's a signal for gold to go up. So gold kind of ensures the value of the entire portfolio by having a small slice. So whether it's fundamental, technical, or just insurance-based, there are plenty of good reasons to have gold.
Well, thanks, Jim Rickards. And just before we let you go, let me just ask you to tell us, when is your new book officially due for publication now?
Thank you, John. The new book will be out. There are 2 dates. For the United States and Canada, it'll be out April 8th, and that's when Amazon will ship it or download your Kindle, or it'll be available in your local independent bookseller. But for UK, Commonwealth, and the rest of the world, it's actually going to be out in an export edition on April 3rd. So with Currency Wars, it was different. It came out in the United States, and it took a long time to get that book shipped overseas. And I know there were a lot of people in the Netherlands and UK and Australia and elsewhere who wanted it, and it took a long time to get it, and it was a little frustrating, and I felt bad about that. But my publisher has done a great job coming up with this export edition. It's the same book, by the way, of course, but it's the foreign edition is paperback, and the U.S. edition will be hardback. But that export edition will be available April 3rd. So for listeners around the world, April 3rd, in the U.S. and Canada, April 8th, but coming up soon. And there's a lot in the book. There's a lot of new material. There's an entire chapter just on gold, but there's 3 or 4 chapters that discuss gold. But there's also aspects of national security, and I talk a lot about the euro, a lot about China, things that I did not cover in Currency Wars. I did get the chance to cover in this new book, so I hope readers enjoy it.
Well, thanks, Jim, and thank you to our listeners. You can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And speaking of Twitter, please share your questions for our next podcast. Use the hashtag AskJimRickards, followed by your question. Wherever you post that on Twitter, we'll find your question. We'd love to hear from you. So goodbye for now, and we look forward to joining you again soon.